los distintos analistas. Y en este caso saludamos a Thomas Friedberger, que es Deputy CEO of Tikehau Capital. Thomas, thank you so much for having us a few minutes.
Thank you very much.
We are seeing how energy crisis and inflation are still the main worries in markets, and we are seeing how investor sentiment remains cautious. What are your expectations from the evolution of markets?
Well, I would say it will depend deeply on the evolution of inflation. Everything is more or less linked to inflation, and I would say on that aspect that there are probably two different types of inflation. There is a cyclic of inflation, which is coming from the quantitative easing policies in mainly in North America and in Europe, also from the COVID recovery policies that have been extremely aggressive in subsidizing, I would say, the consumer, and the crisis in Ukraine, obviously, which is triggering an energy shock. And then there is a structural inflation, which is the reason why we've been advocating for the last 2 years that inflation would come back, which is more linked to demographics, to the change in energy mix worldwide, and also to the I would say pivoting of the Chinese economic model from a model widely based on cheap labor and exports on the basis of an undervalued currency to a model based on a strong domestic market, based on a stronger currency, which is more inflationary. And also deglobalization is also inflationary, as globalization has been deflationary. So I would say there is a structural inflation probably with us for much longer than we think, which explains the fact that markets are still probably a little bit expensive, and that we should be realistic about the fact that inflation is probably with us for the long term. Now, also on the cyclical inflation, what we can say is that if you look at the last time we've had inflation in the world, it was in the 70s. The inflation cycle started probably in 1973, which was after the Yom Kippur War, and it only started to recede in 1982. So it took 9 years to start to see inflation coming back, with rates at 15% in the US. So okay, they were starting from a much higher level, but still. And also something that people don't usually mention is that not only the central banks have been bringing interest rates higher for a longer period to curb inflation, but also inflation has been defeated with a very massive capex boom, capital expenditure boom in the oil industry in the 70s, that has demultiplied the production capacity, and this is unlikely to happen this time because less and less banks are inclined to finance new exploration and production projects in the oil industry. So maybe that this capex boom will happen in the renewable energy sector, but not in the oil sector, and so it will also probably be slightly more inflationary. So for all those reasons, we think that central bank will have to raise interest rates for much longer, and to much higher level than the market anticipates, and that the break-even inflation currently in the market, i.e. 2.5%, both in the US and in Europe, 1 year forward, are way too low, which means that central banks will have to trigger a recession to curb inflation. And so if they succeed to do that, corporate earnings will probably adjust with lower revenues. If they don't succeed to do that, inflation will not fade, and so corporate earnings will probably also face headwinds, but this time with costs that are increasing. So in both cases, we think that corporate earnings are facing headwinds, and that the fact that the global markets are trading on multiples that are more reasonable than before, but still elevated, is a sign that we still need to be prudent.
You said 9 years. Could it take central banks that long to get inflation under control?
Well, nobody knows, right? Nobody knows. Nobody has a clue. But what we can say that the optimism currently in the market that inflation has reached a peak already and will decrease pretty quickly afterwards to converge towards those break-even inflation level, market inflation level, might be very optimistic. So the fact that again. It took a long time in the 70s to curb inflation, and that there are also structural reasons why inflation is with us. It's not only the crisis in Ukraine, push us to be prudent. But that said, that there are already opportunities. It's just that the good thing about inflation and about higher interest rates and also deglobalization is that we will probably have to live in a world with lower growth for the next decades. Companies will be less capable of optimizing, production costs, of optimizing the level of capital they are operating with very thin buffers of capital as they were, they used to operate with, to optimize their taxes. So less optimization, higher interest rates means that they will need to build resilience. And in order to build resilience, they will need to spend money to do some capital expenditure. And that means dispersion, because we often say that CapEx is the enemy of the equity investor, because it's very easy to destroy value by doing bad investments. And actually, it means that the companies that will actually outperform in the next decades are companies that are well managed, with strong governance, doing the best CapEx, and positioned on the mega trends that this CapEx cycle will create, i.e., we think sectors like energy transition or cybersecurity, where companies will need to spend a lot of money. So the good news is that yes, we'll have to live in a world with lower growth, but there will be pockets of high growth still on those mega trends, and that after all, this is probably what this world needs, i.e., a lower growth model, because the current model of seeking infinite growth, exponential growth doesn't work. It has an impact on our environment, on inequalities. It creates bubbles with rates that were way too low, so it doesn't work. We can see those impacts. Environment is the E, inequality is the S, and bubbles, misallocation of capital is the G. So we can see the price of ignoring those ESG criteria, extra financial criteria. So it's not necessarily bad news to live in a world with lower growth, but the good news is that there will be a lot of dispersion, and the best companies will still enjoy decent growth. So it's all about being selective there.
Thomas, next week the Fed will be, our focus will be on Jerome Powell and the Federal Reserve. Is he going to stick in 75 basic points, or 100 hike is possible? What do you think?
Well, 100 is possible. Some people are anticipating it. We are more in the 75 basis points count. But again, I mean, they might do, even if they do only 75 basis points next time, it doesn't mean that it will stop there. So it's probably a cycle that will last for much longer. And after all, that's probably what counts more than knowing if they will do 75 or 100.
And which investment opportunities do you see considering the current market scenario?
So right now we already see a couple of opportunities, but more on the fixed income side, especially in the higher yielding part of the fixed income market. We think that for example, short duration high yield is rewarding the risk pretty well on the short part of the credit curve. But here, if you want to address this opportunity, you need to be highly selective. That's why you need to perform in-depth financial and extra-financial analysis on the issuers. But if you are able to do that, and we think that's what we are doing at Tikehau, there are already great opportunities there. Also in the financial subordinated bond sector, where banks have been suffering from an equity perspective recently. We think that bank debt is now trading on a very attractive level that are rewarding the risk appropriately. So we see opportunities there as well. And then in the equity markets, we see opportunities in sectors that will support those mega trends I was alluding about, i.e. energy transition, cyber security, digitalization of industrial processes, because especially in Europe, we will need to re-onshore a lot of our industrial output, and in order to do that, you need to digitalize supply chains, industrial processes. So all the companies that are allowing this process to happen, tech enablers, as we say, we see a mega trend here as well.
Thomas Friedberger, Deputy CEO on Tikehau Capital. Thank you so much for having us a few minutes. It's a pleasure.